You're not actually watching me right now. You're watching an AI replica trained to deliver financial education at scale. And on this channel, we break down the strategies, markets, and economic forces shaping your financial future. Welcome to our channel, Beyond the Ticker, hosted by Blake and John Wiswell. Let's get right to it. What's up, everybody? Today's video is going to be quick and simple on Stocks 101. Let's break it down, starting with a question. Why do some people get paid when companies grow, even if they don't work there? Think about that for a second. It's not luck. It's not magic. It's because they own part of the company. Today, I'm going to explain how stocks actually work in simple, real-world terms, and why understanding this can completely change the way you think about money. Let's imagine you start a coffee shop. It's doing well. Customers love it. Business is steady. And now you want to expand. Maybe open 3 more locations across town. But expansion takes money. You could take on debt, or you could sell small pieces of your business to investors who believe in what you're building. Each small piece you sell is called a share. When someone buys that share, they now own a small percentage of your coffee shop. That's a stock. It's not just a ticker symbol scrolling across a screen. It's not a lottery ticket. It's ownership. Now the big question, how does that ownership turn into money? There are 2 main ways. First, growth. If your coffee shop expands successfully, more customers, more revenue, more profit, the overall business becomes more valuable. And if the business becomes more valuable, each ownership piece becomes more valuable too. So if someone bought a share at $50 and later sells it for $100, that difference is their gain. They benefited from growth. The second way is through dividends. Some companies take a portion of their profits and distribute them directly to shareholders. That means you can get paid simply for owning the stock, even if you never sell it. And if you reinvest those payments over time, they can compound. And that's where long-term investing becomes powerful. Now let's talk about something that confuses a lot of people. Why do stock prices move up and down every day? It's not random. Stock prices move based on expectations. If investors believe a company will grow, earn more profit, launch better products, or expand into new markets, demand for that stock increases. More demand pushes the price higher. If investors lose confidence, maybe earnings disappoint or future growth looks uncertain, demand drops. And when demand drops, prices fall. At its core, the stock market is simply a massive auction. Buyers and sellers constantly agreeing on what a company is worth at any given moment. It's supply and demand. Nothing more mysterious than that. So why does all of this matter? Because when you invest in stocks, you're not just hoping numbers go up. You're participating in business growth. You're aligning your money with companies that build products, provide services, create jobs, and innovate. Over long periods of time, strong businesses tend to grow. And historically, broad segments of the stock market have reflected that growth. That's why stocks are commonly used for retirement accounts, long-term wealth building, and financial independence strategies. Not because they're flashy, not because they're exciting, but because ownership builds wealth. So the next time you hear someone say, the market went up today, remember what that really means. Businesses created value, and owners benefited. And when you own stocks, you're one of those owners. That's how stocks actually work. If this helps simplify things for you, hit like, subscribe, and let me know what topic you want broken down next. We'll see you in the next video.